All right, let's talk about something we use every single day, but probably don't think about much: money and credit. It seems simple, right? But how we got from, trading stuff to just tapping a card, well, that story is packed with some really smart ideas and, yeah, some pretty big risks too. So let's dive in.
So, have you ever actually tried this? Like really tried to trade something you have for something you want, with no money involved? It sounds kind of straightforward, but you run into a massive problem almost immediately. What do you do if the other person just doesn't want your stuff?
And boom, here's that problem in a nutshell. The shoemaker is all like, I'll give you these great shoes for your wheat. But the farmer says, nope, don't need shoes, I need clothes. See? It's a total dead end. The whole system breaks down. I mean, think about it. Finding that one person who has exactly what you need and wants exactly what you have, that's not a system. That's just hoping for a miracle. It's pure luck.
So, how did we get out of this mess? Well, humanity came up with an invention that completely changed the game, taking us from that clunky barter system all the way to the banks we use today.
Yeah, this problem actually has a fancy name: the double coincidence of wants. All it really means is that you both have to want what the other person has at the exact same time. It's like trying to get two lightning bolts to strike the same place. If you don't have that perfect match, no trade. The whole economy just stops.
And the brilliant solution? Money. It's what we call a medium of exchange. Basically, it's the middleman. Now, our shoemaker can sell his shoes to literally anyone who wants them for some cash. Then he can take that cash and go buy wheat from a totally different person. All of a sudden, luck is out of the equation. Money connects everybody.
Now, what we've used as money has changed a ton over the centuries. I mean, we started with stuff that was just useful, things like grains or cattle. Then we got smarter and moved to things like gold and silver coins, stuff that was easy to carry and didn't spoil. And now, today, most of our money isn't even something you can hold. It's just numbers on a screen, right? Bank deposits, digital currency. That's the world we live in.
Okay, so what are the banks actually doing with all that money you deposit? It sounds complicated, but the basic idea is actually super simple. You put your extra cash in the bank. The bank holds on to a little of it just in case you need to make a withdrawal. But the vast majority, they lend it out to other people, someone who needs a loan to start a business or buy a car. And the way the bank makes its money is on the gap, right? The difference between the interest they charge the borrower and the little bit of interest they pay you. They're basically financial matchmakers, connecting people who have money with people who need it.
And that lending part, that brings us to the other half of this whole story: credit. A loan can be an incredible tool. It can help you build something amazing. But it can also be a double-edged sword. It can be a path to prosperity, or it can be a trap. Let's see how.
Okay, to see what I mean, let's look at two people, Salim and Swapna. Salim, the shoemaker, he takes out a loan to buy materials for a huge festival order. It's a risk, but it pays off. He delivers the shoes, makes a great profit, pays back the loan, no problem. For him, credit was a total game changer. But then you have Swapna, the farmer. She takes a loan for seeds and supplies. But disaster strikes. Pests wipe out her entire crop. Now she has no money, no crop, and she's stuck with a loan she can't possibly repay. The very thing that was meant to help her has just made her life so much harder.
What happened to Swapna? That's what we call a debt trap. It's a brutal situation where the debt becomes impossible to pay back. You get stuck in this cycle where you have to take out new loans just to pay off the interest on the old ones. It's like being in quicksand. The more you struggle, the deeper you sink.
And this really highlights a critical point. It's not just that you borrow, but where you borrow from that matters. There are basically two different worlds when it comes to getting a loan, and trust me, they are night and day.
So, in one corner, you've got the formal sector. Think banks, cooperatives. These are the official guys. They're supervised by a central bank like the RBI in India, which means they have to follow rules. Interest rates are regulated and generally lower. But then, in the other corner, you have the informal sector. This is your local moneylenders, traders, sometimes even your boss. There's no one watching over them, no rules. They can charge insane interest rates and use some pretty nasty methods to make sure they get paid back.
Now, let's look at some real numbers from rural India to see how big this is. Sure, banks and co-ops make up a good chunk of the loans, just over half. But look at the rest. Nearly a quarter of all loans come from moneylenders alone. When you add it all up, a massive number of people are stuck going to these expensive, unregulated, informal sources.
So the obvious question is, why? Why doesn't everyone just go to a bank where it's cheaper and safer?
Well, there's one huge hurdle, one major roadblock that stops the poorest people from even getting in the door.
And that roadblock is something called collateral. The easiest way to think about it is like a security deposit. When you borrow from a bank, you have to offer them something you own as a guarantee. It could be land, a house, a car. If you fail to pay back the loan, the bank has the right to take that asset and sell it to get their money back. It's the bank's safety net.
And this chart, wow, this really shows you the impact of that one rule. Look at rich households in cities. Over 80% of their credit comes from the safe, formal sector. Now look at poor households. It's completely flipped. More than half of their credit comes from those risky, informal lenders. Why the huge difference? It's simple. They don't have the land or the house to offer up as collateral.
And that's really the bottom line. That single requirement, collateral, is the main reason the poor are shut out of the formal banking system. It forces them into the arms of informal lenders, and that's often where the debt trap begins.
But okay, it's not all bad news. There's an incredible solution that's been bubbling up from the ground. A really innovative idea that's helping millions of people get around this collateral problem. It basically flips the whole system on its head.
It's called a self-help group, or an SHG for short. And the way it works is just brilliant. You get a small group, maybe 15 or 20 local women, and they start pooling their savings. Just small amounts, but they do it regularly. From that little pool of money, members can take out small loans for their needs. Now here's the magic part. After a year or two of doing this consistently, the group itself proves it's reliable, and then the entire group can get a loan from a bank. The group's track record and their collective promise to repay, that becomes the collateral.
The power of this is just huge. First, they solve the collateral problem, which is amazing. They give people access to timely loans for all sorts of things. It builds financial independence, especially for women, but it goes even beyond money. These groups become a support system, a place where women can come together and talk about everything from health to community issues.
And this isn't just a tiny feel-good story. This is a proven model that works on a massive scale. Just look at the Grameen Bank in Bangladesh. It was a pioneer of this idea, and today it has more than 9 million members, and almost all of them are women from poor backgrounds. It's a huge success story.
So, I want to end with this quote from Professor Muhammad Yunus, the guy who started the Grameen Bank. He said, "If credit can be made available to the poor, these millions of small people, with their millions of small pursuits, can add up to create the biggest development wonder." And that really captures the whole point, doesn't it? That giving people fair access to credit isn't just a financial transaction. It's about unlocking potential on a massive scale. It shows us that sometimes the biggest changes really do start small.